Okay. Good morning, everyone. So today is our last session on EPS standard. Not much is remaining from the perspective of what we are having to study, except two, three new concepts which I told I will be discussing today. And then we will see a couple of questions as a part of that. Okay, so till now we have seen EPS. It is a link between financial reporting and financial management. It kind of enables the analysts to predict the market price in the future, how the entity will look in the future as far as the market capitalization is concerned. So EPS is broadly of two types. One is your basic EPS, the other is your diluted EPS. Basic EPS, based on the numbers which are already reported, it is a past computation exercise. So depending on the results and the number of shares, we determine the EPS. The EPS is from the perspective of that category of equity shares which is subordinate to all other shares in the capital structure. So that is what we saw. Then we moved further and saw the formula net profit attributable to equity holders divided by weighted average number of equity shares. Weighted average means we are weighing the number of equity shares for the time the shares were actually in issue in the capital structure. Then we moved on to see certain special issue of shares, like one is the bonus. Bonus shares are merely capitalization of reserves. They are always in the capital structure in the form of reserves. They only formally come into equity shares from the date the bonus is actually declared. But for the purpose of EPS computation, the bonus is computed as if they were in the EPS is computed as if the bonus shares were in existence right from the beginning of the earliest reporting period. So we do a restatement of the comparative EPS also. So that is the part related to bonus. We typically use a bonus adjustment factor and multiply the number of shares with the bonus adjustment factor for all the periods prior to the date of issue of bonus. Okay, bonus adjustment factor is pre plus post equity shares divided by pre-equity shares. So that was what we did. Then we saw rights issue. Rights issue is part bonus because we are paying less than the market price. There is a bonus component involved. So typically we compute the bonus component and then we follow the same approach for the bonus component as we did in the preceding period. However, alternatively, the simple step could be you find out a rights adjustment factor depending on the X rights price of the share. And once we find the rights adjustment factor, we then proceed to multiply the rights adjustment factor with all the equity shares in issue right from the reporting period, beginning of the earliest reporting period till the date the rights are actually issued. So that is your rights treatment. Then after that, we came to diluted EPS, which is more of a forward-looking EPS. Okay. Forward-looking in the sense we looked at the potential equity shares in our capital structure. Potential shares could be on account of the presence of either convertible debentures, convertible preference shares, or it could also be on account of presence of options or warrants in your capital structure, which gives the holder a right to exercise the option and get the equity shares. So when we are doing your diluted EPS, we consider the impact of all of them. So when I consider the impact is twofold. One is the denominator number of shares will increase by the potential equity shares. Additionally, the existing profit that I use for basic EPS will also change depending on what are the shares which I am considering potential. For example, if I take a convertible debenture and it is a potential equity share, so in the denominator, I work it out as if the debenture will be converted. Then in the numerator, the net profit attributable to equity shareholders will be after adding the interest that you would have saved on account of the conversion. However, this interest will be net of any tax impact that is there. Okay. So we look at all possible impacts. If if the profit increases as a result of which your management remuneration increases, then that also will have to be factored in the numerator. Okay. So this is what we saw. If I have multiple if I have multiple potential shares in the capital structure, I will have to check which of these combination of potential shares will result in the lowest possible earnings per share. Basically, it is diluted EPS. That means the diluted number must be lower than the basic number. It is possible that certain potential shares could have an anti-dilutive effect. So therefore, there is a mechanism where I look at the incremental earnings that I generate from each potential share and I do the ranking. The ranking will be the least earnings generated, incremental earnings generated will be ranked 1 and then it goes in an ascending order. And basis the rankings, you will go on including in the diluted EPS calculation till I actually get my lowest possible diluted EPS. Where the diluted EPS starts to exceed the basic EPS, that number will not be reported because it will amount to anti-dilution. Okay, so this was what we saw. We saw also a couple of fresh concepts. The first one being preference dividend. Preference dividend under the Ind AS regime is nothing but a finance cost because preference shares generally are redeemable, at least under the Indian Companies Act, it's mandatorily redeemable. So the fact that they are having a the fact that they are having a preference, the fact that their principal is guaranteed to be redeemed, the fact that they are having a fixed rate of dividend, all of these point out to the fact that in substance, this is a financial liability because there is an obligation to deliver cash. So therefore, preference shares in the Ind AS regime will be regarded as a financial liability. Since it is a financial liability, the dividends as such would be imputed into the finance cost, which is already considered when I arrive at the net profit after tax. And therefore, no further reduction is required. So when I do the finance cost working, I apply something known as effective interest rate. I do not take the coupon rate. I do something of an effective interest rate. What do you mean by effective interest rate? Basically, the present value of, I take the cash outflows that is possible. Cash outflows could be on account of yearly payment of dividend, which is nothing but a payout. And then the second one could be the premium that is payable on account of redemption. So these two things, I bring it to the present value using a market rate on similar instruments, and that will be the fair value on which I do the effective interest rate unwinding of the discount. The payout will be treated merely as repayment of a liability. So that is how the treatment goes. The effective interest rate multiplied by the opening balance is what will effectively go and sit in your finance cost. So we will not reduce the preference dividend separately. We will discuss more about this in your financial instruments chapter, so you can understand that better at that point of time. So till now, this was what we had covered. We saw a couple of questions. We saw participating preference shares, where I'm having certain shares which participate in the undistributed profits also. So the preference shares will get their preference dividends. Then the equity shareholders get their dividends. Then the undistributed profits, whatever is left out, in that the preference shares will also participate. So we also saw a mechanism where I formulate a linear equation and then I find out the EPS attributable to the equity shareholder. So that is what we typically did. Okay, so with that, then we saw premium paid on early redemption or conversion. If it is classified as equity, it would generally go to your securities premium or retained earnings. You will have to deduct it from net profit after tax because these funds are not available to the equity holders. However, if it is a liability, these would form a part of your finance cost. You will not have any implications, any further implications. Okay, so that takes care of what we have discussed so far. I think nothing else is left out. Yes. Okay, so the revision part is done. Good morning, Shailesh, Viraj, Muhammad, Ganesh, Yadu, Shruti. Good morning. Good morning. Okay, so I hope that you are able to recollect, follow, and I hope that you could do some of the questions at least which I told you guys to do. So let's hope you do those questions. Okay, and now coming back, good morning, Yukta. Hi, good morning. Okay, so coming back, two, three very important concepts, and that kind of winds up our present understanding. You will get more understanding from financial instruments chapter. I will briefly touch upon those topics today, but you'll get more and more clarity later on. Okay. So coming to presentation of EPS, well, where do you present the EPS? I present the EPS on the face of the P&L. On the face of the P&L. Okay. The face of the P&L, when I present it, it means it's directly visible, and then you may give a note for the computation. These are the practical case also. Now, what are the EPS numbers you present? You present the basic EPS, you present the diluted EPS also. And you also present these numbers for continuing operations and total operations. Okay, you present these numbers for continuing operations, total operations, discontinuing operations. Okay, so these are the numbers which you are going to present. Okay, continuing, total, discontinuing, basic, and diluted, all of them on the face of the P&L. Okay, now it's all there in that presentation. Okay. All right. Uh, yeah, fine. So diluted EPS, we saw this. Free element, we saw this. We saw this. Okay. Okay. All right. Now, couple of important facts. Okay. Let us understand this with the help of the example. Okay. Assume the following facts for company XY. Income from continuing operations 30 lakhs, loss from discontinued operations 36 lakhs, net loss is 6 lakhs, weighted average number of shares 10 lakhs, incremental common shares relating to stock options 2 lakhs, required to calculate the basic and diluted EPS for company XY from the above information. Assume if in the above case loss from continued operations is rupees 10 lakh, income from discontinued operations is 36 lakhs, calculate the diluted EPS. Okay, fine. So let us proceed to calculate. This is answer to part A. Okay. Basic EPS, net profit attributable to equity shareholders divided by weighted average number of equity shares. So how much does that come to? Well, continued operations, continuing operations is equal to 6 lakhs is the total loss. Income from continuing operations is 30 lakhs. Shares is 10 lakhs. Three per share. Okay. Then we move on to the discontinued operations. Is equal to, my loss is how much? 36 lakhs. divided by 3.6 negative. And finally, total operations 6 lakhs divided by I'll not go fast. I thought last time was more of what you know already. So that is why I just sped up. Obviously today I won't because today's session is a little new, is a set of new concepts. So we'll keep it not very fast. Okay. So basic EPS all done. Coming to diluted EPS. Diluted EPS, we are having in our capital structure the presence of stock options. Stock options is similar to your options to take the equity shares, which we saw. You will take only the bonus element. In this case, the bonus element only is given to you. Incremental common shares. That is 2 lakhs. They have not said total option. They have said incremental options. So the free element is 2 lakh shares. The free element is 2 lakh shares. So now, continuing operations. Is equal to divided by plus 2 lakh. So that comes to how much? 30 by 12. Perfect. Next, discontinued operations. This is way too simple. That is why I'm not explaining anything much. Okay. But there is one concept that will come shortly. Okay. This is a loss, right? So rupees 3 per share. Okay. Have you understood so far? Have you understood so far? Good morning, Tanisha. Good morning. Good morning, Akshara. Yes. Have you understood so far? Any doubts here? Okay, perfect. So now look at this number and look at this number. What do you think? What is happening? Is there a dilution that is happening or is there an anti-dilution that is happening? Look at the total operations number. Is there a dilution or is there an anti-dilution? Mohammed, what is happening? Shailesh, Viraj, Yadu, Ganesh, Shankar is not there today. That's right. It's anti-dilution. 0.6 is a higher loss as compared to 0.5. As per what we studied, anti-dilution means we should not report this. We should stick to say that basic EPS is 0.6 and the diluted EPS also we will not report, saying that there is an anti-dilution that is happening. Yes, so that is our understanding so far. But Ind AS 33 says, no, wait. You will not look at total operations figure for the purpose of dilution or anti-dilution. The standard says your continuing operations is your control number. This is your control number. Okay. This is your control number. If there is a dilution in the control number, if there is a dilution in the control number, that is the EPS from continuing operations, then you report the diluted earnings from total operations even though there is an anti-dilution. समझ में आ रहा है? If my continuing operations shows a dilution, which is a control number, then you still continue to report this. You still continue to report this, though there is an anti-dilution. Though there is an anti-dilution. Are we clear with this? Sir, ऐसा क्यों? Why is that so? Sir, that is so because you have already disclosed the fact that there is a potential dilution in your EPS. Sir, where? Sir, I disclose continuing operations separately, no? So if I disclose my continuing operations separately, I am already disclosing the fact that there will be an anti-dilution. There will be a dilution in the future. Now, total operations does not matter whether there is a dilution or anti-dilution. Whatever is there, you disclose, provided the EPS from continuing operations shows a dilution. Are we clear with this? Yes. Because the continuing operations EPS is what the reader of financial statements will actually be interested in. Total operations is just a mathematical number now when I have continuing and discontinued operations. Okay. So therefore, total operations you disclose whether it is diluted or anti-diluted, provided the control number exhibits a dilution. The control number is nothing but EPS from continuing operations. Okay. All right. So this explanation is there in the study module itself. It is there in the study module itself. Just a second. The income from continuing operations is the control number. There is a dilution in the basic EPS from 3 to 2.5. Therefore, even though there is an anti-dilution, the diluted loss is reported. Even though there is an anti-dilution, the diluted loss per share of 0.5 is reported. Is it okay? Yes. Have you guys understood? Any doubts here? Anybody has any doubts so far? No doubts? All clear? Yes. So now let us move on to part B. Part B. Okay. Okay. Now coming to part B. क्या बोलता है? Assume if in the case loss from continued operations is 10 lakhs, income from discontinued operations is 36 lakhs. Okay. Okay. This is the loss. Now, basic EPS 10 lakhs divided by how many shares do I have? 10 lakhs. rupee 1 per share divided by 12 lakh shares. So this results in how much? 10 divided by 12. This is -1. Okay. Tell me what is happening here. Continuing operations. Is there a dilution or anti-dilution? Follow. Is there a dilution or anti-dilution? That's right. That's right. Okay. All right. So, you look at this, you look at this. What is happening is an anti-dilution. What is happening is an anti-dilution. Okay. Now, coming to overall operations. Coming to overall operations, income from discontinued operation 36 lakhs, loss from continuing operations 10 lakhs. So 36 minus 10, 26 lakhs is the overall income. Basic EPS is equal to divided by 2.6. Diluted EPS. Will I report this diluted EPS? Will I report this diluted EPS? Answer is no. Why will I not report? Because my continuing operations is already exhibiting an anti-dilution. So I will not report this diluted EPS. It makes no sense for me to report it. Are we clear with this? Yes. Are we clear with this? So your control number is your EPS from continuing operations. If that shows a dilution, you will always show the dilution from total operations, regardless of whether it will be diluted or anti-diluted. If the continuing operations EPS exhibits an anti-dilution, then the diluted EPS from overall operations need not be shown. Need not be shown. Is it okay? Yes. Are we clear with this? Why is that so? Obviously, the reader of financial statements will be interested in continuing operations. Understand what is diluted EPS. Diluted EPS is a forward-looking number. And when I say a forward-looking number, it means it not only captures the potential shares in the capital structure, it also captures the income side. And that also of the operations that are going to continue in the future. That is why the continuing operations, that is a critical number for us. That is a critical number for us. Okay. So with that, we complete this part of control number. Okay. Very, very important. Very, very important. Okay. Shruti, is it clear, beta? Yes. Everybody, Yadu, Manoj, is it clear? Shailesh, Mohammed, Ganesh. Oh, there is a new lady here, Nandini Narayan. Okay, all right. Is it clear, everyone? Okay, all right, great. So that takes care of one new concept for you. Now we move on to another new concept, that is contingently. I hope you guys are noting this down side by side wherever you feel it necessary. Okay, coming to contingently issuable shares. Contingently issuable shares. Okay. Contingently issuable shares means what? These represent shares which are going to be issued in the future depending on certain conditions that are going to be fulfilled. This represents shares which will be issued in the future based on what? Based on fulfillment of certain conditions. Sir, example batao. Sir, example is suppose, okay, we had a recent acquisition somewhere in 2020 or just before that, where L&D acquired Mindtree. Okay, we had this particular acquisition. Now, L&D acquired the Mindtree company's shares. If you want, you can go through that overall timeline because it was a classic case of hostile takeover. Okay, so practically it was a war. Like, are you aware of this? Yes, it was practically a war-like scenario. जहाँ पे पीछे से from the back L&T came in. Okay, basically L&T already had some shares in Mindtree. L&T also got this cafe coffee day owner who was there, who passed away due to suicide. He was holding a substantial chunk of shares. So L&T entered into a bulk deal with that person and the Siddhartha, okay, of Cafe Coffee Day. They entered into an agreement with Siddhartha to acquire his shares. And once they acquired his shares, L&T became a significant stakeholder. Did not cross 50, but they were somewhere in the range of 20 to 25% by then. Mindtree started to feel the heat at that point of time. So they came out with all possible, what you can say, they came out with all possible disclosures, all possible guarantees, etc. But L&T did a master stroke by going directly to the public and said, give us your shares. And it offered a premium over the market price. So L&T acquired close to 30-35%. And with that, L&T got nearly 60 to 65% somewhere in the month of June 2020 or 21, if I am not wrong. And once it got, immediately the step that it took was change the board, put its own guys on the board, and it is now running Mindtree. Okay, so it was a classic case of hostile takeover. Okay, you can go through that. Okay, now I just build up on that example. Okay, suppose it was to be a normal takeover where L&T approached Mindtree. Mindtree said, okay, you can acquire us. Okay, L&T tells the promoters of Mindtree, okay, look, you are going to give us your shares. We admire that. But Mindtree people say there's nothing to admire. We are a profitable entity. We are not giving you, we are giving you the shares because you already have a right over us. Okay. You are already in a better position, but we need something more. So L&T will tell, look, I'll not give you cash. But suppose if your profit increases by 2 times on account of the acquisition, or your revenue from operations triples on account of the acquisition within 3 years from the date of acquisition. If these conditions are fulfilled, then we are going to give you additional shares. Then we are going to give you additional shares. So this is one example of contingently issuable shares, where shares are going to be issued subject to fulfillment of the revenue condition, subject to fulfillment of the uh, profitability condition. So if that be the case, sir, then in L&T's capital structure, don't you think I'm having potential shares? Potential का मतलब क्या है? Potential means what? In future, it is possible that these shares will come and exist. It is possible that these shares will come and exist. So when I have this kind of an arrangement or this kind of an agreement, don't you think that this is going to give rise to contingently, is going to give rise to potential shares in the books of L&T? Yes or no? बोलो यार. Yes, it is a potential share. Sir, but वो condition है, होने दो ना. Let it be. I'm not worried about the condition. I'm just saying, do I have an instrument which possibly generates, which possibly gives rise to increased equity shares in my capital structure? Answer is yes. So therefore, this contingently issuable shares will be now an additional concept for the purposes of basic as well as diluted EPS. Okay, basic as well as diluted EPS. Before you jump, sir, basic कैसे ये तो potential हो गया. I'll come to that. But as of now, you understand that contingently issuable shares is a significant part of your diluted EPS, but it has implications on the basic EPS also, which we will see right now. Now, your contingently issuable shares always based on agreement. It is always based on an agreement. Okay. There is no, you cannot have contingent shares without an agreement. Okay. Now, let us look at the implications. Let us look at the implications. Okay. Sir, implications on basic EPS and implications on diluted EPS. Okay. Basic EPS, diluted EPS. Okay. Between basic and diluted, basic is based on past information. Basic is based on past information. So in this case, shares should be included in weighted average number of equity shares from the date the conditions are fulfilled. From the date the conditions are fulfilled. That is, the shares become issuable. The shares become issuable. So basic EPS still retains the requirement of it being a number based on the past data. That means it is saying that condition should be fulfilled. So once you're aware that the condition is fulfilled, from that date, you are going to have, the shares actually becoming issuable. So here there is no ambiguity, there is no confusion. It actually waits for the conditions to be fulfilled. It actually waits for the conditions to be fulfilled, and then the shares end up becoming issuable. So in your weighted average number, from the date the shares become issuable, these will be included. So that is your basic EPS. Fairly simple, no doubts, no queries, very clear. Coming to diluted EPS, यहाँ पे I want you to think, थोड़ा सोचो. See, L&T has told Mindtree, if your revenue triples within 3 years from the date of acquisition. Okay, if it triples within this, so let me draw some timelines for you. Let us presume the acquisition happened on 1st July 2020. So 31st March 21, 31st March 22, 31st March 23. So the condition says that if your revenue triples by 2023, if your revenue triples by 2023, the shares will become due for issue. The shares will be issuable. Okay. Now you tell me for 2021, they are potential equity shares. They are potential equity shares. Everybody agrees. For 21-22, they are potential equity shares. For 22-23, they are potential equity shares. Sir, but revenue condition will be met on 31st March 23 now. Revenue condition will be met on March 23, but when? The time is still night. Your revenue numbers will be frozen till 11 hours, 59 minutes, 59 seconds in the midnight of 31st March 2023. And therefore, the earliest date when your shares will become issuable is 1st April 2023. You cannot say that close of business, I will declare the revenue. ऐसा नहीं होता है. Particularly in today's times. If I go back 10, 15 years back, I would agree with you that after the close of office hours, revenue nahi hoga. But today's times, let us just assume that we take a condition like, we take a case like, what we can take, take any streaming service. Okay, take Netflix for example. You subscribe to Netflix, there is a very good series that has come, and you wanted to watch it. You came from your office, 31st March, everything got over, you finished your work, you know that you are having long days ahead. So perhaps you thought that I will enjoy my series after coming from office. So you came from office at 9 p.m. You subscribed to Netflix at 10 p.m. and started watching the series. Now, 10 p.m. on 31st March 23 is the date revenue has accrued for Netflix for that particular day. Because the subscription is in tranches of 1 month each. So it will be from 31st March till 30th April. That means 8 दिन का revenue आएगा Netflix को. Netflix will have 1 day's revenue on 31st March. So in today's fluid times, you cannot really have after office hours revenue won't be recognized as a cutoff date. Your cutoff date for all practical purposes extends till midnight. It extends till midnight. You need to have controls and systems in place to recognize it. Even in manufacturing entities, 31st March means there is a whole lot of billing that happens late in the night. And then the dispatches are ready, your freight forwarders will be there waiting at your doorstep to take the material. You will have companies who will put their freight forwarders to pick up the material. All these things happen at the fag end of the year, after office hours. So now it's no longer a case of office hours. It is a case of prior to 12. Okay. So till the last minute, you are going to wait. And then the earliest you will come to know is 1st April when you open the billing report, you will understand whether you have tripled the revenue or not. So therefore, the shares will become issuable only on 1st April 2023. That means on for the year 22-23 also it remains potential. For the year 22-23 also it remains potential. Now my question to you is, भाई ये तो कहानी हो गया. This is a story. Now the question to you is, for the purpose of 2021, 21-22, 22-23, these represent potential equity shares. All of you have agreed. Now answer the question, how am I going to compute the diluted EPS? How am I going to compute the diluted EPS? That's right. Hospitality service also. Absolutely right. Why hospitality? Take your aircrafts, okay, airlines, okay. You have a takeoff that happens at 11 or 55 minutes in the night, okay. So when are you going to recognize the revenue? That is a different aspect altogether. Let me not get into that, okay. So now you tell me potential equity shares. How am I going to compute my diluted EPS? What do you think? The diluted EPS, I need two things. One is the earnings, net profit attributable to equity shareholders divided by weighted average number. So weighted average number will be existing actuals plus the potential equity shares. So now my question is, how am I going to compute? Because these are dependent on a condition. These are dependent on a condition. So, I'm happy that I'm not getting the answers today because that means you guys are actually thinking. No answers. People are engrossed in deep thoughts. Yes, no. Come on, guys. What is troubling you? At least write that. What is troubling you? Okay. So I got an answer which goes to say that you people are thinking in the right direction. Okay. Sir, we estimate that we will probably need the condition and then do the inclusion in the potential shares. Okay, so what is one of the answer is, sir, we need to estimate. We need to estimate in the future. जब थोड़ा सा certain होता है. चलो. Let me talk about estimates. What about if an event like COVID-19 happens again? What if COVID-19 happens again? We cannot estimate. Okay, we cannot estimate. Okay, forward looking estimates are prohibited in financial statements. Okay, forward looking estimates are prohibited in your financial statements as far as EPS is concerned. Okay, now sir हम estimate भी नहीं कर सकते, we cannot estimate. There is a ban on that. But they are potential equity shares. But they are potential equity shares. So if they are potential equity shares, if they are expected to be there in the capital structure, but they are dependent on fulfillment of a condition, and we cannot estimate that, then that means we should not include it only. ऐसा भी नहीं है. The standard setters understood that there is a deadlock here. The standard setters understood that there is a deadlock. There is a conflict. And therefore, here is what the solution they proposed. Here is what the solution they proposed. Shares are to be included in the current year as potential equity shares only if the shares are issuable considering the current period to be the end of the contingency period. Considering the current period to be the end of the contingency period. Sir, matlab kya? In our example, we saw that additional shares will be issued if revenue is tripled by 3 years from the date of acquisition. So we are in the year 2021. If I am in the year 2021, you have to assume that 2021 is the end of the contingency period. It is not. I know that it is not. Okay, don't jump. It is not the end of the contingency period. But I assume that it is the end of the contingency period ends on 31st March 23. The earliest when the shares become issuable is 1st April 23. So actually the contingency period ends here. But Ind AS 33 tells us, assume that the current period is the end of the contingency period. Sir, current period means 2021 is the end of the contingency period. Did you triple the revenue? Answer is no. If no, then shares won't be included in your weighted average number. Sir, but I have tripled my revenue in the current year itself. I got a very good order because I merged with L&T Infotech, and therefore I am going to go ahead and I got a big order and I tripled my revenue in the first year itself. If yes, then you include it in your potential equity shares right from 2021. Right from 2021. Okay. Now, that is the first condition. So the first condition is basically eliminating forward estimation. Forward estimation. Sir, how? Sir, it is saying considering the current period to be the end of the contingency period, you include. That means in the current period, if the criteria is fulfilled, include the potential. If it is not fulfilled, don't include. Very simple. Okay. Now, coming to second condition. Sir, which date? From which date should I include? Potential shares will be included from the date of the contingent share agreement or the beginning of the year, whichever is later, whichever is later. Okay, ये तो टाइमलाइन. Okay, from which date will I include my potential equity shares? Okay, this is just a timeline. Okay, all right, so you can note these two things. Okay, third. Okay, is it clear till now? Is it clear till now? Yes. Now, there is a third problem. Okay, there is a third problem which Manoj has already said. Sir, 2021, assuming it to be the end of the contingency period, I thought I did not meet the revenue condition. So therefore, the diluted EPS was not considered. 21-22, I met the condition. I met after the potential shares will be included from the date of the contingent share agreement. I thought my handwriting is not so bad. Or the beginning of the year, whichever is later. Whichever is later. This is a fact. This is a fact. We are not assuming anything here. Because assuming that the current year is the end of the contingency period, that means you know year has ended. You got the actual revenue numbers. So the fact is there. Only one assumption you are making. That is the current period is the end of the reporting period. Okay. I am not making any assumption that I will need it in the future. I will get an order in the future. The synergies will be visible in the future. No, I am not making that assumption. I am assuming that as on today, if the contingency period is over, did I meet the condition? You look at the revenue numbers. No? Have you met? Answer is no. So if you haven't met, don't include it in your potential equity shares. Because today's date, you have not met the condition. But sir, it is a future-based estimate. Yes. But I cannot make a future-based estimate. It goes against my conservatism to a huge extent. Okay. So India's is not pro-conservatism, neither is it against conservatism. It relies on realism and facts. Okay. So in this case, did I meet it? Answer is no. So I assume that current period is end of the contingency period. That means 2021 is end of the contingency period. Did I meet it? Answer is yes. Then include the potential shares right now itself. Okay. But suppose you did not meet in 2021, don't include. You will not include. Sir, I met it in 21-22. Include it in 21-22. Okay. But sir, comparative bhi to hota hai, there is something known as comparative. So if I met the condition in 21-22, do I have to restate the position in 2021? Do I have to restate it in 2021? Answer is no. You did not include it in 2021 because the circumstances as on 31st March 21 confirm that you have not met the revenue criteria. And since you have not met the revenue criteria, you did not include it. 21-22, you actually met the criteria, you are including, but 2021 you did not meet, you will not include. It was a factual assessment, and based on the facts you did not include, those facts have not changed. And because those facts have not changed, you will not do a prior period restatement. You will not do a prior period restatement. Okay. So here, prior period restatement is not needed. Is not needed. So there could be some students who will be having this doubt in their mind. Sir, 2021 did not meet. 21-22 I met, so I will include it. But 21-22, meeting it does not imply I will do a restatement of 2021. Because 2021, you actually had the fact that you did not meet it. And therefore, you did not include it. So no restatements required. Are we clear with this? Yes, are we clear with this? Boys, Muhammad, Manoj, Yadu. Okay. Muhammad has asked a question. Sir, ESOPs with vesting conditions, will it come under this? Answer is yes. Yes. We do it subconsciously. Okay, we do it subconsciously in the sense that you include ESOPs as a part of your diluted EPS. Okay, you include ESOPs. See, okay, since he has raised the question, let me tell you what happens. Okay, suppose I issue shares to my employees. Okay, I give them a vesting condition of 3 years of service. And when I give them a vesting condition of 3 years of service, and thereafter I do the exercise. Thereafter I do the exercise of the options. So year 1, year 2, year 3, and then it is the exercise. Now in year 1, my diluted EPS, I include the options. It's not mentioned specifically, but I include the options. Now, so far I was including the options, compute the free element, take the impact, and then do the diluted EPS, etc. But subconsciously, I was following this because if the employee is there till the end of the current year, I assume it to be the end of the reporting period and I do the working. That means behind my brain, what is triggering this assumption is this. Okay. So subconsciously, I do follow this. Only thing is, it's not exactly visible. If the employee leaves and goes in year 1 without fulfilling it, I know I'm not going to issue shares to him. So he will obviously not be included in that. Okay. So we do follow this, but only thing is it is not explicitly mentioned. Only thing is it is not explicitly mentioned. Okay. All right. So that takes care of contingently issuable shares. And there is a very nice question in your study module, which we are now going to solve. Mark it as a very important question. Okay. It's extremely important. Hence, let us start solving it. Okay. All right. This is the last major concept for all of us. Okay. Then we are having only financial instruments. I need to touch up a little bit. Apart from that, we are done. Okay. Participating is considered. Okay. All right. This is the one. Okay. Read the question, please. Ordinary shares, 10 lakhs. There were outstanding during 20x1, 10 lakhs. No options, warrants, convertible instruments outstanding. They made your life easy. An agreement related to a recent business combination provides for the issue of additional ordinary shares based on the following condition. 5,000 additional ordinary shares for each new retail site opened during 20x1. 1,000 additional ordinary shares for each rupees 1,000 of consolidated profit in excess of rupees 20 lakhs for the year ending 31st December X1. Retail sites opened during X1. On 1st May, you opened one site. On 1st September, you opened another site. Consolidated YTD profit attributable to ordinary equity holders of the parent entity. 11 lakhs, this is YTD, okay, year to date. This is for the first 3 months. This is for the first 6 months. This is for 9 months ending September. And this is for the year ending December. Calculate basic and diluted. So we are going to do this in 2 steps. First one is we will do it for the entire year. Then we will do it for each quarter. Assuming that it is interim reporting, we will do it for each quarter, and that kind of settles the issue and debate for contingently issuable shares once and for all. Okay? All right. Now, this is illustration 12. This is illustration 12. Okay. Coming to this first one, date of agreement. Date of contingent shares agreement. Have they given the date? No, sir. They haven't given the date. So we will have to assume that it is made at the start of the year. Assume to be at commencement of the year. Okay. So that is your date of contingent shares agreement. Okay. Second, contingency conditions. A. What are my conditions? 5,000 shares for each new retail site opened. Retail condition. Opening of retail site. It is only opening which is important. It is not necessary that it should function throughout the year. All that is required is opening of the retail site. Okay. So, satisfied when store is opened. Need not operate for entire year. It's not mentioned. Okay. So, you need not worry about it. Okay. B. Earnings contingency. Earnings contingency. Earnings contingency क्या बोलता है? For each 1,000 of consolidated profit in excess of 20 lakhs. Okay. So, profit for year as a whole satisfied at the end of the year, at the end of the year. So for the purpose of basic EPS, you will include the shares when the retail site is opened. You will include the shares when you meet the profit requirement at the end of the year. So this is the first part. Second part is diluted EPS. You will include it from the beginning of the year because date of contingency agreement, you have assumed it to be beginning of the year, depending on the conditions existing at the end of the year. That is as if the requirements are met. As if the requirements are met. Okay. So that is a background of the understanding of this question. Now let us start computations. Okay. EPS for the year. Okay. EPS for the year. Basic EPS is equal to, okay, basic EPS is equal to, acha. Basic EPS, is it a forward-looking number or based on past data? Sir, it is based on past data. So very simple. My job is in fact very simple. What is my total profit that I have earned? They have given here. See, year to date profit 11,23,90 rupees 29 lakhs as of 31st December X1. So 29 lakhs. Okay. All right. Now कितने shares थे? Okay. How many shares are there? Sir, starting 10 lakh shares, these are there for the entire year into 12 by 12 plus. Acha. My shop is opened. Yes, sir. When is your shop opened? Sir, my shop is opened on 1st May. That means May till December, a period of 8 months, these shares will be there. And 1st September, that means for a period of 4 months, September, October, November, December. Okay. So plus 5,000 into 8 by 12 plus 5,000 into 4 by 12. Are we clear with this? Yes. Sir, profit condition is 29 lakhs. Yes. You will be issuing additional shares for every 1,000 rupees earned in excess of 20 lakhs. Sir, I have earned 9 lakh rupees in excess of 20. So therefore, I should get 9 lakh additional shares. Yes, the 1,000 shares for every 1,000 earned. That means 1 share for 1 rupee earned, right? So you are earning 9 lakhs more than 20. So therefore, you should be getting 9 lakh shares. My question to you is, will I have 9 lakhs included here or not? This is my question. Will I have 9 lakhs included here or not? Will you have 9 lakhs included in the basic EPS or not? Yes. Think and answer. सोच समझ के जवाब दो. Okay. Don't just blindly say I will include. Look at which EPS you are calculating. Look at the condition and then give me the answer. Okay. Okay. I presume you guys have done your articleship or are doing your articleship. Okay. Boys, there is no noise from the boys. Yadu, Shailesh, Mansha, Viraj, Manoj. What do you guys think? Mohammed, what do you think? Include or not include? Okay. You earned 29 lakh profit. Okay. You earned 29 lakh profit. That means you earned 9 lakh more than 20. When are you going to come to know that you have earned 29 lakhs worth of profit? When are you going to come to know that? Are you going to know it on 31st March or will you know it after 31st March? Very simple question. आपने 29 lakhs कमाया. You have made a profit of 29 lakhs. When are you going to know that? Are you going to know that on 31st March or will you know it after 31st March? Will I know it after 31st March? When am I going to know that I earned 29 lakh worth of profit? Seedha question. When will I come to know? Will I come to know on 31st March? Will I come to know on 31st of March or will I come to know after 31st of March? The earliest, even banks take 1st April off and audit starts, operations start from 2nd April because 1st April they have a lot of things to run. They have a lot of things to run. 31st March ko everywhere is a chaos because what happens on 31st March is you will make a sale, you will be focusing on revenue, banks will be focusing on giving the loans. Everywhere there is a mad rush for revenue. On 1st April, if you are a bank, you will start to post the interest entries. You will start to pay interest on deposits. You will start to debit the interest on monies given to your customers. So all these things will happen on 1st April. If I talk about a manufacturing concern, you will do the production postings on 1st April. You will ensure that the stock checks match with the books. And if there is any adjustments, you will do that on 1st of April. All of these activities will happen on 1st April with effective date 31st March. With effective date 31st of March. And therefore, the only time you come to know you have earned 29 lakhs is after 31st March. I am talking about basic EPS. I am talking about basic EPS. Since I'm talking about basic EPS is based on past data. Is based on past data. As on 31st March, I did not know my profit. I did not know my profit. So therefore, as on 31st March, I cannot issue the equity shares. I cannot issue the equity shares. And since I cannot issue the equity shares on 31st March, I cannot include the 9 lakhs in my basic EPS. I cannot include the 9 lakhs in my basic EPS. So if I do this, I get my basic EPS at 2.89. 2.89. Okay. Retail contingency, I met it on 1st May 20x1, 1st September 20x1. 5,000 shares issued as condition satisfied. The same holds true for the second one. But earnings contingency, 31st December, not yet satisfied, hence not considered, will be effective from 1st January 20x2. Will be effective from 1st January 20x2. Just check your calculations once. It is 29 lakhs divided by 10 lakh 5,000. 2.89. It's 2.8855. Okay. Just check the calculation. Are we clear with this? Are we clear with this? You will include it with effect from. You will include it with effect from 1st January 20x2. You will include it with effect from 1st January 20x2. Because that is the date you will actually issue the shares. That is the date you will actually issue the shares. Are we clear with this? Yes. Okay. Clear? Okay. So that takes care of basic EPS. Coming to diluted EPS. Coming to diluted EPS. I don't have convertible debentures, convertible preference shares, any other warrants, etc. Nothing is there. So as far as my earnings is concerned, there won't be any change. There won't be any change. No savings on potential shares. Okay. Now, this is going to be 10 lakhs into 12 by 12 plus 5,000 into plus 5,000 into. Okay. What am I going to take as the time? Do I take it 8 by 12 and 4 by 12, or do I take it as 12 by 12 and 12 by 12? सोच समझ के जवाब दो. Think and answer. Think and answer. Okay. Don't rush. Understand the condition. The condition is potential shares will be included from the later of the date when the shares became issuable or the date of the agreement or the date of the agreement. Okay. Sorry, the beginning of the year or the date of the agreement. My mistake. Contingent shares will be included from the beginning of the year or the date of the agreement, whichever is later. In this case, both are the same. In this case, both the dates are the same. So tell me now, will I take it as 8 by 12 or 4 by 12, or will I take it as any other number? Okay. Think and answer. Be attentive. The question is going to get slightly complicated now. It is going to be 12 by 12. It is going to be 12. Sir, Q 12 by 12. See, 1st May, you actually made an issue. So 1st May till 31st December, this 8 months is actual. So it goes in the basic. But from 1st Jan to 1st May, this 4 months, these shares were potential. These shares were potential. You will do the diluted EPS inclusion right from the beginning of the year or date of agreement, whichever is later. In this case, it is going to be the same because we have assumed that date of agreement is at the commencement of the year. So therefore, the diluted EPS will be considered right from the beginning, number one. Second one, we are assuming that the current period is the end of the contingency period. Based on that, we are having shares issued, that is 5,000 for the site opened on 1st of May, 5,000 for the site opened on 1st of September. So assuming that the current period is the end of the contingency period, we have opened 2 sites and therefore 5 plus 5 we will include 10,000 bonus, 10,000 potential shares in our weighted average number of equity shares right from the beginning of the year because that is the period which is later than the commencement of the year or the date of the agreement. Are we clear with this? Yes. Are we clear with this? Anybody has any doubts? Anybody has any doubts? Okay. Taken from earlier of date of agreement that is 11x1 or to start of year. Whichever is later. Whichever is later. Okay. You can think about it like this, or, sir, we always do diluted EPS as basic is the starting point, plus basic is the starting point, plus additional. So we used to take net profit basic plus adjustment. We used to take weighted average basic plus adjustment. So वैसे करेंगे, so if I do it like that, 10 lakh 5,000, this is at Waynes for basic plus 5,000 shares. These were potential 1st April to 1st Jan to 1st of May potential plus 5,000 shares 1st January to 31st August potential. And then immediately from 1st May and 1st September, they are going to whichever is later, Baba, whichever is later. Okay. Sorry. Just erase this. Okay. Taken from date of agreement or start of the year, whichever is later. Okay. Okay. All right. Plus potential. So हो गया, you get the same thing. Okay, you get the same thing. Okay. For 4 months, it is potential, and for 8 months, it is potential. If you do the weighted average, you are going to get another 5,000 from here. Okay. 9 lakh shares. Sir, ये कौन से 9 lakh है? The profit contingency. You have earned more than 20 lakhs. You have earned 9 lakhs more than 20 lakhs. You are entitled to 9 lakh shares. Will you include 9 lakh here or not? Think and answer. Will you include 9 lakh here or not? Will you include 9 lakh here or not? Yes. Shruti, will you include 9 lakhs? Okay. That's right. You will include 9 lakhs here. Sir, but your profit, when are you going to compute your EPS? Will you compute your EPS on 31st March, on 31st December, or will you compute the EPS when you finalize the statements? You will do the EPS computation when you are doing the finalization. Finalization will be maybe 15 days, 20 days, 1 month, 2 months, 3 months, 6 months. I don't know. But it will definitely be after 31st of March, after 31st of December, sorry. So when you finalize after 31st December, that means you already know from the P&L you have finalized whether your profit is exceeding 20 lakhs or not. So you already know that the profit for the year ending December is 29 lakhs, and therefore you also know that you have to include it at 9 lakhs. But sir, some people may ask, sir, 9 lakh at the most will be issuable on 31st December, because 31st December is the day when the profit gets finalized. So we should take 9 lakh into 1 by 365. I cannot take it that, because it is a potential share to be included from the beginning of the year or the date of agreement, whichever is later. In this case, both are the same. And therefore, it will be included right from 1st of January. It will be included right from 1st of January. Okay. So plus 9 lakhs. And here also, if you do it as the alternative, you will get plus 9 lakhs. Okay. How do I get this 9 lakhs? Earnings contingency 29 minus 20 divided by 1000 into 1000. 9 lakh. Yes. Okay. 9 lakh shares. We are included. And therefore, if you now proceed to calculate, it will be 10 lakh 10,000 plus 9 lakh. So 19 lakh 10,000. 19 lakh 10,000. The earnings contingency will not form part of basic because these shares were never issued on 31st December. But it will form part of diluted because they are potential. Because they are potential. Okay. So this comes to how much? If you do the division, 29 lakhs divided by 19 lakh 10,000. So that comes to how much? 1.5183. 1.5183. Okay. All right. So is the diluted number lower than the basic? Answer is yes. So since it is lower, we can report the diluted EPS. We can report the diluted EPS. Are we clear about this? Are we clear about this? Yes. Anybody, any doubts, any difficulties? Done? Okay. So this takes care of the annual calculations. Okay. Now we move on to quarterly calculations. Okay. I hope you guys have noted. Now we move on to quarterly profits. Okay. Q1, Q2, Q3, Q4. YTD profit 11 lakhs for Q1. For Q2, it is 23 lakhs minus 11 lakhs. So that is 12 lakhs. Next is 19 lakhs. So there is a 4 lakh loss. And then finally, it goes to 29 lakhs. Okay. So these are your quarterly numbers. We will now present this data on a quarter-wise basis. Okay. We will now present this data on a quarter-wise basis. Okay. Did you at quarterly profits? I don't think you need any explanation from my side. Okay. Shall we start? Boys and girls, girls and boys. I'll come to that. Shailesh, I'll come to that. Okay. Okay. All right. Fine. So first we start off with Q1. So first we start off with Q1. Q1, my profit is 11 lakhs. Okay. Divided by. Sir, I have 10 lakh shares in my capital structure. I did not meet the retail contingency nor the profit contingency. So therefore, both the cases is 0 and therefore my EPS is 1.10 per share. It is 1.10. Q1 is Jan to March. So you have opened the store in May. That means for the first quarter, koi store open tha hi nahi. And therefore, the profit contingency is 0. The earnings contingency is also 0. Okay. All right. Coming to diluted EPS. Sir, here also earnings to 11 lakhs. No doubt on this. Divided by. Sir, here also I have 10 lakh shares. Acha. Sir, the potential shares countdown starts from 1st of Jan. But I have to assume that current period is end of the contingency period. That means by 31st March, the contingency period is over. So by 31st March, did I open any of the sites? No, sir. The site you opened only on 1st of May. So therefore, assuming that 31st March is end of the contingency period, you did not open any retail site and therefore you have not fulfilled any of the retail conditions. This is number one. Second one is you will be entitled to a number of shares if your profit is over and above 20 lakh rupees. Assuming that March is the end of the contingency period, you have earned a profit of only 11 lakh rupees till now, and therefore you will not be entitled to any further share because your profit is below 20 lakh, and therefore the profit contingency also is zero. And therefore, the diluted EPS is again 1.10 per share. It is again 1.10 per share. Okay. So that takes care of Q1. Coming to Q2. My earnings here is 12 lakhs. Divided by. Okay. Sir, here I have 10 lakh shares. Plus. Now, I have met the retail contingency. Retail contingency is opening a store. Store is opened on 1st of May. So May and June, 2 months in the current quarter, the store is open. My shares will be issuable or issued from 1st of May. And therefore, that 5,000 will definitely come here. But sir, the problem is, will an additional number on account of profit contingency come? Answer is no. Because that is the annual profit. You are going to look at it at the end of the year only. And therefore, that is not going to come. So this is going to be rupees 12 lakhs divided by 10 lakh, 3,333. So that gives you how much? 1.20 per share. 1.20 per share. Okay. Next, 12 lakhs. Diluted EPS. Sir, ऊपर तो 12 lakhs है. We start with the basic EPS means 10 lakh, 3,333. I missed 1 3. Plus. Sir, the 5,000 shares were actually in issue from 1st May till June, but they were potential for a period of 1 month. Because assuming that 30th June is the end of the contingency period, I have fulfilled the retail condition of setting up, opening one store. I opened one store, I met the retail condition, I have to include the diluted shares right from the beginning of the year or date of agreement, whichever is later. In this case, it is the beginning of the year, that is 1st of Jan. So that is not 1st of Jan, sorry. In this case, it is 1st of April, the beginning of the quarter. And therefore, it is going to be potential for a period of 1 month. And actual for 2 months. Actual for 2 months is already included in 10 lakh 3,333. So therefore, this is going to be plus 5,000 into 1 by 3. Plus 5,000 into 1 by 3. Okay. Will I have any profit contingency? Answer is yes. You have earned a total profit of 23 lakhs. Assuming current period to be end of the contingency period, you have earned 3 lakhs more than 20. And because you have earned 3 lakhs more than 20, you are entitled to 3 lakh shares. And you are entitled to 3 lakh shares from the beginning of the period. or the date of agreement, whichever is later. In this case, beginning of the period is 1st April, date of agreement is 1st of Jan, whichever is later is 1st of April. So it will be right from the beginning of this quarter. How many shares are you going to include? Sir, I am going to include 3 lakh shares. So therefore, plus 3 lakhs into 3 by 3. So that gives you 12 lakh divided by 13 lakh 5,000 shares. $0.92. अरे आपको इंटरेस्टिंग लग रहा है कि नहीं? Are you finding this interesting or not? Yes. All right. Let us now come to Q3. Let us now come to Q3. Okay. Q3, I have a loss of 4 lakhs. I have a loss of 4 lakhs. Okay. Now, Q3 is for which period? Sir, Q3 is for 1st July till 30th September. 1st July till 30th September. So I have 10 lakh shares. I have already fulfilled one shop. I opened one shop. तो वहां का 5,000 आएगा ही आएगा. 5,000 into 3 by 3. And now I have opened another shop. Now I have opened another shop. That shop is opened on 1st September. That means in this quarter, it is there only for 1 month. That is for the month of September. So therefore, 5,000 into 1 by 3. 5,000 into 1 by 3. So this gives you 4 lakhs divided by 10,06,667. So 0.397. There is a reason I am writing it up to 4 decimals. You can write it up to 2 decimals. That is also okay. But there is a reason why I am writing up to 3 decimals. 3 or 4 decimals. Okay. All right. So that takes care of Q3 basic. I hope that is clear. Coming to the next one, rupees 4 lakhs for diluted earnings divided by 10 lakh 6,667 plus. Sir, 5,000 shares of May is already included in 10 lakh 6,667. 5,000 of September is included for 1 month. But I am talking about diluted EPS. So potential shares included right from the beginning of the year or date of agreement, whichever is later. In this case, it is the beginning of the quarter. That is 1st of July. So it will be potential for a period of 2 months. It will be potential for a period of 2 months. So plus 5,000 into 2 by 3. 5,000 into 2 by 3. Acha, will I meet the earnings condition? Answer is no, because my profit till date is falling down to 19 lakhs. So therefore it is below 20. So I have not met the earnings contingency. So therefore this becomes zero. Sir, this has become zero, but previous quarter you took it as 3 lakhs. Do I have to restate the previous quarter? Answer is no. Because previous quarter the conditions indicated that you have met the condition. But in this case, the conditions indicate that what condition was met, you have lost that, and therefore there is no need to restate the Q2 figures. Okay, so that comes to 4 lakhs divided by 10 lakh 10,000 shares. Okay, fine. Look at these numbers. Dilutive or anti-dilutive? Dilutive or anti-dilutive? ये loss है by the way. Sorry, I did not put a bracket. Is the impact dilutive or anti-dilutive? Yes, it is a loss. So tell me, is it dilutive or anti-dilutive? Basic EPS 0.397 negative, diluted EPS 0.396 negative. Is it dilutive or anti-dilutive? You cannot ignore the decimals. That is why I am saying, okay, you cannot ignore the decimals. It is anti-dilutive. Ideally, it is anti-dilutive. So that is why in this question, this data becomes important, including 4 lakh 50 loss from a discontinued operation. So my total loss is 4 lakhs. Out of 4 lakh 50 is lost due to discontinued operation. That means my continuing operation has a profit of 50,000. Therefore, profit of continuing operation is actually 50,000. Is actually 50,000. Are you able to follow? See, my quarter has made 4 lakh loss. But in this 4 lakh loss, I have 4 lakh 50,000 loss from discontinued operation. That means there is a 50,000 profit of continuing operations. And therefore, if I talk about control number, that is going to be rupees 50,000 divided by 10 lakh 6,667. So 50,000, 10 lakh 6,667, 0.04967 per share. And here this is going to be 50,000 divided by 10 lakh 10,000 shares. So 50,000. So this is 0.0495 per share. Okay. So is this anti-dilutive? Is this dilutive? Yes. This is dilutive. And therefore, if this is dilutive, I can continue to report. Continue to report. Continue to report. Are we clear with this? Yes. All right. So since the control number exhibits dilution, you can report the total EPS even though it exhibits anti-dilution. And in fact, if you look at your solution of the institute in this regard, see, they have given here number 14. Because the loss during the third quarter is attributable to loss from discontinued operations, anti-dilution rules do not apply. The control number is positive. 50,000 in our case, the control number is 50,000, that is positive. Okay. Accordingly, effect of potential ordinary shares is included in the calculation of diluted earnings per share. Okay. So that takes care of Q3. Coming to Q4. Coming to Q4. Q4. Rupees. Hey, what is the profit? 10 lakhs. Divided by how many shares do I have now? Sir, I have 10 lakh shares. That's right. I also have 5,000 shares which were issued in the month of May. So it is there for the entire quarter. I also have 5,000 shares issued in the month of September. So it is there for the entire quarter. And I do not have the basic EPS including the profit contingency because profit I come to know only after the year ends, and therefore this is going to be 10 lakhs divided by 10 lakh 10,000, 0.99 per share. Coming to this is again 10 lakhs divided by 10 lakh 10,000 shares plus. Sir, will I include 9 lakhs? Answer is yes. Here you are meeting the profit contingency because the shares are potential for the entire year. So though you are meeting, you come to know you get the profit contingency in the next year. But since you are computing the EPS in the next year only pertaining to the current year, you know you have met the profit contingency. You will include the potential shares from the beginning of the quarter or date of agreement, whichever is later. In this case, beginning of quarter, that is 1st of October. So therefore, 9 lakh shares will be included for the entire quarter. For the entire quarter. And this comes to 10 lakhs divided by 19 lakhs. 526 per share. Achha, is it dilutive? Answer is yes. So you can freely go ahead and report this. Okay. So that takes care of contingently issuable shares. Okay. Q1, Q2, we have done all the possible permutations and combinations. So sir, when it is an anti-dilution after negative, okay, and a dilution after, see, you look at the control number. The control number is dilutive. You report the overall earnings regardless of whether it is dilutive or anti-dilutive. If the control number itself is anti-dilutive, you will not report the overall dilution. You will not report the overall dilution. Okay. अरे प्रॉब्लम तो खत्म हो गया ना, अब तो ब्रेक ही ब्रेक है. यस, प्रॉब्लम इज ओवर. Okay, so that takes care of contingently issuable shares. ठीक है. We have completed the major part of Ind AS 33. Okay, all that is required is explained to you. Okay. Uh, we take a quick 10-minute break. We will resume at 9:10. Only thing is you have, see the next part, I will quickly touch upon some concepts of financial instruments, but that will be more clear to you when you study financial instruments chapter. Okay. So what happens is, though I may speak today on financial instruments, there will be a disconnect. You're able to understand there will be some kind of disconnect. So I will try to keep it as simple as possible. Today, at this stage, and I'm leaving you with the end of today's session, even if you are unable to interpret financial instrument related questions, it is fine. It is fine. Reason being, you are yet to understand financial instruments. Okay. So therefore, don't expect that suddenly I give a concept and you are able to follow. At this point, it may be possible you may think, sir, to ratta marne ko keh rahe. I'm not saying you to by heart, but for today's session, probably you may feel that it is fine. Everything is fine because you haven't studied yet. The moment you study there, connect the dots to EPS, I'm sure you will be able to understand. Same goes for another question on holding and subsidiary. That question also you will have to do it after you complete your consolidation adjustments. Okay, because there and this, there are many chapters where this is happening. Okay, because I start teaching a chapter, and it's the issue with other faculty also. I don't deny that. See, I'm taking a session on income tax next weekend, the coming weekend. Okay, that income tax has an implication on business combination. But suppose business combination was done and then you had to do income tax, then there would be a small gap left there. Okay, that is the nature of the problems here. They are somewhere going to get correlated. So we will take a quick break, understand a little bit of financial instruments, not much, and then we shall see one question and then we wind up the session. Okay, so that's it. Thanks everyone. No, no, unfortunately, or you have a, I'm not taking financial instruments this time. Okay. I think Kapileshwar sir is going to take. Okay. I'm not very sure. I'm not taking. Okay. All right. So, he will be taking both the sessions, consolidation as well as financial instruments. Okay. All right. So take a quick break. We'll resume at 9:10. Okay. We resume at 9:10. श्रुति विल से जान छूट गई सर फाइनेंशियल इंस्ट्रूमेंट आप नहीं पढ़ा रहे हो ओके चलो ऑलराइट ब्रेक So that takes care of contingent, contingently issuable shares. So the large part of the standard, as I told you, is already complete. We have one or two things left over. I only need to quickly discuss that for you, and then I'm done with the topic. Okay, let me see, where do I start? Okay. Okay. See, as of now, you just note down a couple of things that uh, should kind of do some benefit for you. But okay, fine. You can give the heading financial instruments and EPS. Okay. Now we have something known as compound financial instruments. Okay, which is nothing but what we call convertibles. It could be convertible debentures or convertible preference shares, for example. Okay, it could be convertible debentures or convertible preference shares, whatever be the case. Okay, all right. Now it becomes a little difficult for you to, for me to explain, but let us start. Okay, all right. See, this is divided into three categories. Okay. First one is compulsorily convertible. Okay. The second one is optionally convertible. Optionally convertible. At the option of the holder. The third one is optionally convertible at the option of the issuer. At the option of the issuer. Okay. Now, in all these scenarios, in all these scenarios, in all these scenarios, see, you have to understand one thing. When I talk about financial instruments, and in that I talk about financial liability means an obligation to deliver cash, an obligation to deliver cash. Okay. So when I talk about convertibles, you can write somewhere on top, unless otherwise given, comma, unless otherwise given, comma, interest will always be settled in cash. Interest will always be settled in cash. Hence, financial liability. Hence, financial liability. Okay. hence financial liability. When I say financial liability, I mean the interest stream of cash flows will be a financial liability. Okay, the interest is the financial liability. I'm not talking about the principal. I'm not talking about the principal. Okay, I'm not talking about the principal. Because each financial instrument liability will, each instrument of this type will have two cash flows. One is interest, the other is principal. So interest, unless given above, will always be given otherwise, will always be payable in cash. So therefore, it is a financial liability. As far as principal is concerned, no obligation to deliver cash. No obligation to deliver cash settled in fixed number of equity shares of equity instruments. Settled in fixed number of equity instruments. Treat as equity. Treat as equity. Not a liability component. Not a liability component. Okay. It is an assumption. It is an assumption. Normally, they will not specify it. Okay. But it is a reasonable assumption to make. This interest is a reasonable assumption to make. You will study this when you do financial instruments. Okay. Okay. All right. Okay. Next. Optionally convertible at the option of the holder. Principal. Interest की तो बात हो गई ना. Principal. See, this is optionally convertible at the option of the holder. मतलब if Reliance gives a convertible debenture to you, you have the option to ask Reliance, give me cash or give me share. Reliance will not have the option. You have the option. So therefore, for Reliance, it is a hanging sword. वो कभी भी उसके सर पे गिर सकता है. It can fall on its head. क्या? The requirement of cash. The requirement of cash. So therefore, it is in the nature of a financial liability. As holder can demand cash. As holder can demand cash. Basically, what this is it is a liability, no doubt, but the holder can also demand equity share. The holder can also demand equity share. So it is something more than a liability. It is something more than a liability. Take it as Reliance has given you this instrument. ये instrument primarily you can ask cash, but उसके ऊपर ना there is a topping. That topping is the option for equity. That topping is the option for equity. So it is a financial liability with an embedded derivative. Embedded समझते हो? You know what is embedded? Embedded means it is fitted in that instrument. Okay, so the instrument is a liability. उसके अंदर में you have put this component of equity also. So we call it as an embedded derivative. So we call it as an embedded derivative. Okay. Now, accounting will be part of financial instruments. Okay, so that part you can have a look at that later. Okay, coming to the next one, issuer's option. This is at the option of the issuer. Principal. Reliance has given you convertible debentures, but Reliance will decide, will I give you cash or will I give you equity? Reliance will take the decision. Reliance will take the decision. Okay. So therefore, in this case, generally taken as equity. Generally taken as equity. Alternatively, if if management has no option to has no intention to convert, no intention to convert, Reliance will say, why should I convert? My stake is going to go down, Mukesh Ambani will say, and therefore don't convert, we will settle it in cash. If management has no intention to convert, treat as financial liability for redemption. For redemption. Okay? For redemption. Okay? So this is the fundamental of financial instruments in EPS. Okay? In EPS. Now the question is, how do I come to know whether I have to apply financial instrument assumptions or do it using the normal what that question answer sheet which I gave you? I gave the disclaimer, na, excluding assumptions on financial instruments, excluding financial instruments applicability. Do I have to do it like that or do I have to apply financial instruments? How will I come to? How will I come to? So therefore, the hint is if market rate of similar non-convertible debentures is given, determine liability and equity component. Basically, my compound financial instrument means it is a hybrid instrument showing both equity and liability characteristics. Okay? ठीक है? Okay. वैसा नहीं होगा श्रुति. See, when I say embedded derivative, it means the holder always has a right to ask for cash. See, Ind AS 109 requires you to be conservative about some things. Okay, one of that is an optionally convertible instrument. See, optionally convertible instrument means the instrument, the holder will decide whether he wants cash or whether he wants equity. The entity accounting this instrument cannot assume, क्योंकि वो सोच नहीं सकता कि holder क्या मांगेगा. The entity can never predict what the holder of the instrument will demand. You look from the perspective of the holder. Holder के पास cash है. Yes, it has the option to ask for cash. Along with that option, there is an option for asking equity also. So when he goes to the entity for redemption, he will ask मुझे cash दे दो, or he can ask मुझे equity दे दो. So therefore, it is either of the two options. It is either of the two options. Okay. We give preference to the fact that the holder can demand cash. So it is prudent for me to show it as a liability because under Ind AS, the obligation to deliver cash. The obligation to deliver cash indicates that you are having a financial liability. The holder has an option to ask for cash. So primarily this instrument becomes a cash, an instrument requiring you to deliver cash, and therefore it becomes a financial liability. But it is not only a financial liability. It's not only a financial liability, because वो liability के बदले में equity भी मांग सकता है. He can ask for equity also. So it is a financial liability with the option of converting to equity. So the option of converting to equity, that option becomes an embedded derivative. That option becomes an embedded derivative. ठीक है? इसका detailed accounting is there in your financial instruments. Today, if I go discussing that, we will exceed our timelines. Okay. All right. So now, if market rate of similar non-convertible debentures is given, determine liability and equity component. So I basically do a split accounting. This is application of financial instruments. You will be given the market rate. If market rate is given, institute expects you to follow financial instruments. You cannot say, I will do the regular way like how I used to do in intermediate. You won't get any marks. If market rate is given, it is a silent hint that please follow financial instruments. Don't use your head and do what you used to do in intermediate. Okay. So once you apply this, what are you going to do? Add number of shares on conversion in denominator, not equity component. Okay. This is the first thing that you do. The second thing that you are going to do is, in the numerator, add interest, which is liability component into effective interest rate. Do not add coupon interest, as it is not a finance cost but a payout. Okay. इतना याद कर लो आज के लिए. That is more than sufficient. Okay, this much should take care. I will, okay, just note this down. We will see one quick question. I will run you through the institute solution itself. Okay, how they have treated it. So you will be able to understand that. Okay. ठीक है? Note it down. Okay. So we come to question number 14. Illustration 14, sorry. Okay. I will quickly run you through the question. We will see the hint which tells us it has to be a financial instruments question, and we will solve it accordingly. Okay. An entity issues 2000 convertible bonds at the beginning of year 1. The bonds have a 3-year term, okay, and are issued at par with a face value of 1000 per bond, giving total proceeds 20 lakhs. Interest is payable annually in arrears at a nominal annual interest rate of 6%. Okay. Interest is payable annually in arrears at a nominal annual interest rate. This is your coupon rate. This is your coupon rate. Okay. Next. Each bond is convertible at any time up to maturity into 250 ordinary shares. The entity has an option. Entity has an option. Okay, so we are in the third category. Issuer has an option to settle the principal amount of the convertible bonds in ordinary shares or in cash. Interest will go in cash. Okay, but the principal can be settled in equity or in cash. When the bonds are issued, the prevailing market interest rate for similar debt without a conversion option is 9%. This is the hint. This is the hint. If this hint is given to you, you have to do it using financial instruments. You cannot do the intermediate concept what you are following. At the issue date, the market price of one ordinary share is rupees 3. Ignore income tax. Entity has accounted for the convertible instruments using the principles of financial instruments. Even if this sentence was not given, you had to do it using financial instrument principle only. Interest at 6% for the year has already been adjusted in the profit attributable to shareholders. Calculate basic and diluted EPS when profit attributable to ordinary equity holders is 10 lakhs, ordinary shares outstanding 12 lakhs, convertible bond outstanding is 2000. Okay. Now, how am I going to do this? How am I going to do this? Okay. Let me see how to explain this to you. Basic EPS is simple. You have profit attributable to equity holders, that is 10 lakhs, which is this figure, divided by number of equity shares, 12 lakhs. So 0.83 per ordinary share. This is simple. The problem arises in diluted earnings, where we have to determine the interest that I will have to add back. See, I am having 2000 convertible bonds, convertible into 250 ordinary shares. So 2000 into 250 gives you 5 lakhs. 2000 into 250 gives you 5 lakhs. So denominator is clear. 12 lakh existing plus 5 lakh potential. Numerator is 10 lakhs. The whole problem arises with the finance cost. Ki bhai, what should I add back? What should I add back? Okay. So now let us take a quick look. They have done a shortcut. थोड़ा सा they have taken a shortcut. Okay. I am having bond value of 20 lakhs, right? 1000 face value 20 lakhs. Okay, just look at how it is getting solved. You need not note this term. Okay, 20 lakh is the value of the bond. I split it into the liability component. Okay, and the equity component. Okay, now obligation is to deliver interest in cash, not the principal. So 20 lakhs into 6%. This is how you are going to solve it. Okay. Multiplied by present value annuity factor of 9% for 3 years. Okay. Rate of interest is 9% on similar non-convertible instruments. Why do I do this and all? Please check your financial instruments chapter. Okay. That I cannot explain right now. Plus 0. You are not going to redeem the principal in cash. So that is 0. So this will be 3,03,720. And your equity component will be the balancing figure 1696,280. 1696,280. And now, if I have to determine the interest is equal to 3,03,720 into 9%. So that gives you 27,335. Okay. 303,720 into 9%, 27,335. This is what is getting added here. Because this is the finance cost which is reported as an expense in your profit and loss. So 27,338 is going to get added back, which gives you your diluted EPS. You cannot add back 20 lakhs into 6%. 1,20,000 आप add back नहीं कर सकते because that is not deducted in the first place. That is not deducted in the first place. What is deducted is the liability component multiplied by the effective rate of interest, which is 9% in our case. That is why 27,335 or 338 is deducted. That only is added back and you arrive at the calculation of your diluted EPS. Okay, so आज के लिए only go with this much learning because I cannot explain whole financial instruments to you. It is a limitation of the chronology that we are having. Okay, but the moment you finish your financial instruments, you don't even have to wait to finish. There is a compound financial instruments topic or split accounting. The moment you finish split accounting, please come and do this question on EPS. That will make more sense at this time. That will make more sense at this time. Is it okay? Yes. All right. So that takes care of this. And then we move on to the next one. Next one mein kya hai? Nothing specific is there. Okay. All right. So we have completed almost all the things. I think let me just brush up what all is left out. Nothing is left. Contingently issuable. Okay. This one, go through it for homework. Nothing major is there. Just like how you treat options, same way it is. Okay. We did this question. Okay. Yeah, options are there. So this is basic EPS, diluted EPS. Please do this question. We have seen options, diluted EPS, basic. We did this question also already. Okay. Yes. Yeah. All right. Great. So that's it from my side. Let me just, there is one small topic, return put option. Okay. There is that return put option. A written put option. Okay. A written put option means an entity has written an option to buy back its own shares. An entity has written. Written means what? Somebody is okay. What do I explain? Are you familiar with call options and put options? Are you guys familiar with call options and put options? Put option is an option to sell. Option to sell, in our case, equity shares. Okay. So I have A Limited and I have the option holder. The option holder holds a put option. This put option entitles the option holder to sell the option. A has written the put option. Written the put option means if the option holder exercises his option to sell, A Limited is obligated to buy. A Limited is obligated to buy. Option holder is the one holding. A limited becomes the option writer. A limited becomes the option writer. And therefore, call is to buy, put is to sell. Very simple यार. Call मतलब आप call कब करोगे? When you want something आप call करोगे ना. तो call means to purchase. Put means जो आपके पास है आप उसको बेच रहे हो. You are putting it to sell. So put, there's no confusion in that. Put means to sell. जो आपके पास है, I have this phone. I'm putting it for sale. So put option. मेरे पास ये फोन नहीं है. I called to find out the price. So it becomes a purchase. So call option is for purchase. So when the holder has a put option, the writer is obligated to buy the shares if the holder exercises the put option. If the holder exercises the put option. So in this case, if the number of options is 1000, I'm just giving a simple example. You can do the question based on this understanding. If the number of options is 1000, exercise price is rupees 20 and market price is rupees 10. Market price is rupees 10. So therefore, there is a free element in this option. Free element in option is equal to 1000 options. It will be exercised for 20 rupees, but the market price is only 10. So the free element in the option is 1000 shares. 1000 shares. And this is potential, which will go in your diluted EPS calculation. Which will go in your diluted EPS calculation. Okay. So that is the only thing which is there in relation to written put options. Rest, I don't have anything much to explain. You can go through this particular example which is there. Assume that an entity has 160 written put options outstanding on 160 of its ordinary shares with an exercise price of 10. So that means the holder has the option to sell the shares for 10. So I have the liability to buy at 10 if he exercises. So the put obligation is 1600. The average market price is 8. The average market price is 8. In calculating the diluted EPS, the entity assumes that it issues 200 ordinary shares at 8 to raise the proceeds to satisfy the put option. The difference between 200 and the 160 ordinary shares is added to the denominator in calculating the diluted EPS. That means what? See, I have 160 into 10, an obligation of 1600. Market price is 8. So 1600 by 8, 200 shares I will issue notionally to get the cash to satisfy this obligation. But when I issue 200 shares, I am going to get back only 160 shares. So therefore, 40 shares is what will go as a free element. 40 shares is what will go as a free element in your diluted EPS calculation. In your diluted EPS calculation. Impact on earnings is 0 because this is typically not having any earnings impact. It is just a cash impact. It is just a cash impact. Okay. So that's it. Written put options, not very important as such. Okay. All right. So that takes care of all the questions, everything. All the topic is done, taken care of. I have done all the questions. Only this financial instruments is left, and this one you can do it after you complete holding subsidiary. After you complete holding subsidiary. Until then, leave these two topics in pending. I have a class with you in the month of February. I know the schedule tentatively. So in February, we'll be having probably some 1 or 2 classes. That time, if you have doubts in these questions, please ask me. I will address that. But I need you to do the Jan session before you can do the before you can attempt these questions. Okay. So with that, we conclude. Just give me a minute. Just give me a Okay. So I need you to get these concepts right of holding, subsidiary, and financial instruments. Then we can do these questions if you are still not clear. If you are still not clear. Okay. So with that, we conclude our discussions. Okay. EPS is otherwise a completed topic. I don't have anything further to add. Anybody has any doubts or queries or anything, please let me know. Please let me know. Okay. Anybody has anything to say, anything to add, anything to suggest? Okay. Or you are not happy. Anything is there, please let me know. Okay. Boys, is it okay? Is it okay, boys? Girls, no response. Are you guys online? All good? Okay, fine. So with that, we end our discussion for today. See you guys on सैटरडे आई थिंक वी आज ही कर देता हूँ अपलोड ठीक है आज ही अपलोड मिल जाएगा आपको सो यू गो थ्रू दैट ओके एंड प्लीज revise EPF. Yes, there are a lot of questions. I have done all the major questions. You should be able to solve the remaining questions based on that. Okay. So thanks everyone and see you guys on Saturday with income tax. Okay. See you guys on Saturday with income tax as a major, as the standard in the S12. Okay. All right. Thanks everyone. Thank you, Manoj. Thank you. Thanks, Shruti. Thanks, Manish. Thanks, everyone. Thanks, Akshara, Tanisha, Yukta, Viraj, Shailesh, Ganesh, Yadu. Thanks, everyone. Okay, Nandini. Okay, perfect. So, bye-bye. Take care. Bye. Okay. Yes. Thank you. Session done? Okay. ठीक है. All right. Thank you.